The upside gap 3 methods pattern symbolizes a continuation phenomenon in the stock market, indicating a potential extension of the current bullish momentum. This pattern surfaces on the candlestick chart, which is a tool used by investors to gauge market sentiment and possible price movements. It specifically emerges during an uptrend when there is a gap followed by a small-bodied candle, which is then succeeded by a long bullish candle that closes within the body of the first candle but does not fill the gap. This arrangement suggests that despite a brief pause, the buying pressure remains strong, and the upward trend is likely to persist. In conclusion, navigating the bullish seas requires understanding such technical patterns, as they provide significant insights into market dynamics and future directions. The upside gap 3 methods as a bullish continuation pattern signals that while there may be slight pauses or pullbacks in a trending market, the overall sentiment remains optimistic. Investors and traders can leverage this information to make more informed decisions, aligning their strategies with the prevailing market momentum to capitalize on potential opportunities. Understanding these patterns empowers market participants to navigate the complexities of the financial markets with more confidence and foresight, enhancing their ability to achieve their investment objectives amidst the ebb and flow of bullish trends. In the world of financial markets, a window, also known as a gap, is a concept that investors and traders often come across. It signifies a space between 2 adjacent candlesticks on a price chart. This situation occurs when there is a noticeable difference in the price levels of 2 consecutive candlesticks, with no trading happening in the gap area. Essentially, it highlights a moment where the price jumps from one level to another without any trades occurring between those levels. To understand this better, imagine looking at a chart where each candlestick represents a day's trading activity. On one day, the candlestick might close at a certain price, and on the following day, it opens at a significantly higher or lower price, leaving a visible gap in the chart. This gap is what traders refer to as a window. Windows are significant to traders for several reasons. They can indicate a strong buying or selling pressure, leading to a rapid price move. For instance, if a stock closes at $50 one day and then opens at $55 the next day, it suggests a strong buying interest. Moreover, windows can also act as support or resistance levels in the future. A window created by a sharp price increase may act as a new support level, meaning the price is unlikely to fall below this gap easily. Conversely, a window created by a sharp decrease might act as a resistance level, making it hard for the price to rise above the gap. Understanding windows is crucial for traders as they provide insights into market sentiment and potential future price movements. While they represent a technical analysis concept that might seem complex at first, with practice, they become an invaluable tool in a trader's toolkit to navigate the markets more effectively. Identifying the window in the context of candlestick charting involves recognizing a gap that indicates a space between 2 adjacent candlesticks. This concept is crucial for technical analysts and traders because it signals potential market movements or trend reversals. To identify a window, one should observe the chart for a space where the low price of a candlestick does not touch the high price of the preceding one in a bullish scenario, or where the high price of a candlestick does not touch the low price of the one before it in a bearish scenario. This gap usually represents a strong buying or selling pressure that was not met with counteraction, causing a sudden jump in price from one candlestick to the next without any trading happening in the gap area. Understanding how to spot and interpret windows can provide valuable insights into market sentiment and potential price movements. For example, a window in an uptrend may indicate continued bullish momentum, whereas a window in a downtrend can signal increasing bearish sentiment. However, it's also important to consider other factors and indicators in analysis to form a well-rounded view of the market's direction. A window, also commonly referred to as a gap, signifies an empty space between two adjacent candlesticks on a price chart. This space represents a sudden shift in market prices where no trading activity occurs within the gap range. Essentially, it indicates that the lowest price of the current candlestick is higher than the highest price of the preceding candlestick in the case of an upward gap, or the highest price of the current candlestick is lower than the lowest price of the preceding one in the case of a downward gap. Windows are noteworthy events in technical analysis as they convey crucial information about market sentiment. Regarding market sentiment and the window, the appearance of a window in a price chart is a strong indicator of the prevailing market emotions and future price movements. For example, an upward gap might suggest bullish sentiment, where the demand for the asset outweighs the supply, causing the price to open higher than the close of the previous session. Conversely, a downward gap may indicate bearish sentiment, where the supply exceeds demand, leading to a lower opening price. Traders and analysts closely watch these gaps as they can provide trading opportunities and insight into potential reversals or continuations of trends. In essence, windows not only serve as a visual marker of sudden price changes, but also as a lens through which market psychology can be understood. Their analysis is integral to developing strategies that align with the dominant market sentiment, offering a path to navigate through volatility and make informed decisions. In the context of financial markets, particularly when analyzing candlestick charts, a window refers to a gap indicating a space between two adjacent candlesticks. This gap represents a price range in which no trading occurred, signifying a significant level of volatility and interest in a specific financial instrument within a short time frame. The nature of the window can signal either a continuation or reversal of the current trend, based on its position and the market conditions surrounding its formation. A continuation window occurs within a prevailing trend and suggests that the current momentum is strong enough to propel the market in the same direction beyond the gap. For instance, in an uptrend, a continuation window indicates that buyers are in control and are pushing prices up, skipping over a range of prices without any opposition from sellers. Conversely, a reversal window signals a potential change in the market direction. It often appears after a substantial move in one direction, suggesting exhaustion of the prevailing trend and the beginning of a new opposing trend. For instance, if a window appears at the top of an uptrend, it may indicate that buyers are losing control and sellers are starting to push the prices down, potentially leading to a downtrend. Understanding the implications of windows in candlestick patterns requires analyzing the context in which they appear, including preceding and following candlesticks, as well as the overall market conditions. This helps traders make informed decisions, whether it concerns maintaining confidence in the continuity of the current trend or preparing for a potential reversal. Confirming a window, which is a gap indicating a space between two adjacent candlesticks on a price chart, involves validating its significance and potential impact on future price movements. To confirm a window, one should observe subsequent candlesticks to see if the price continues in the direction the window suggests. For instance, if the window is upward and the following candlesticks maintain or increase the newly established higher price level, this can be seen as a confirmation of the window. Additionally, increased trading volume during and after the formation of a window can serve as further confirmation, as it indicates strong buyer or seller interest at the new price levels. Moreover, it's essential to consider the broader market context and other technical indicators. A window might form during a period of significant news or market events that could influence the market's direction. Similarly, aligning the window with technical indicators such as moving averages or momentum oscillators can provide a more comprehensive view of the market sentiment. This approach helps in making informed decisions by highlighting potential resistance or support levels introduced by the window, thereby guiding traders and investors about possible entry or exit points. In summary, confirming a window in technical analysis is not only about observing the gap between candlesticks, but also involves a thorough examination of subsequent price action, trading volume, and the interaction with other market factors and technical indicators. This multi-faceted analysis enables traders to gauge the strength and potential impact of windows on their trading strategies. In the context of technical analysis in financial markets, a window, also known as a gap, represents a space between two adjacent candlesticks on a chart. This occurs when there is a significant price movement in the market with no trading occurring in between, effectively creating a gap in the price chart. Windows can provide valuable insights into market sentiment and potential future movements. However, their reliability and limitations should be carefully considered. The appearance of a window can signal the start of a new trend or a sudden shift in market conditions. For instance, a gap up, where the price suddenly opens higher than the previous day's high, might indicate strong buying pressure and a bullish outlook. Conversely, a gap down could signal selling pressure and a bearish trend. Windows are particularly noteworthy in markets where price gaps are less common, suggesting a significant change in market dynamics or information. Despite their potential insights, windows have limitations and should not be used in isolation for making trading decisions. Their reliability can be influenced by the market's overall trend, volume, and the context in which they appear. For instance, a window that occurs on high volume may be more significant than one on low volume, as it reflects stronger market conviction. Moreover, gaps may eventually be filled, the price may return to the level it was before the gap occurred. While some traders view gaps as targets for the price to eventually return to, there is no guarantee this will happen. It is also essential to consider other technical and fundamental factors affecting the market, as windows do not provide a complete picture on their own. In summary, windows or gaps in price charts are important technical analysis tools that can indicate shifts in market sentiment. However, traders should be aware of their limitations and use them alongside other analysis methods to make informed decisions. In technical analysis, a window refers to a gap that indicates a space between two adjacent candlesticks on a chart. This gap shows that there was a significant move in the price of an asset, either up or down, with no trading occurring at the price levels within the gap. These windows can be an important indicator of market sentiment and future price movements. Integration with other analysis tools enhances the significance of a window. For example, when combined with trend lines or moving averages, a window can signal the strength of a trend or hint at a potential reversal. If a window forms in the direction of the prevailing trend, it might suggest the trend is strong and likely to continue. Conversely, if a window appears against the direction of the trend, it may indicate the trend is weakening and a reversal could be forthcoming. Furthermore, volume analysis can provide additional insights. A window accompanied by high trading volume suggests a strong conviction in the price move, giving the signal more reliability. On the other hand, if the volume is low, the gap might be less significant and could potentially close, meaning the prices may return to the levels before the gap occurred. In essence, when analyzing windows or gaps on a chart, it is valuable to consider them in the context of other technical analysis tools. This holistic approach can offer more nuanced insights, helping to make more informed investment decisions. In discussing the concept of a window, which refers to a gap indicating a space between two adjacent candlesticks on a financial chart, it's crucial to illuminate common mistakes and misinterpretations that may arise. A window manifests when the low price of the current candlestick is higher than the high price of the preceding candlestick in an upward trend, or conversely, when the high price of the current candlestick is lower than the low price of the preceding candlestick during a downward trend. This phenomenon is often seen as a signal for potential continuation or reversal in market trends. One prevalent misinterpretation is the assumption that a window guarantees immediate trend continuation or reversal. Investors may act hastily upon spotting a window without considering other market indicators or the broader market context. Such an approach overlooks that, although windows can be significant indicators, they are not foolproof predictive tools on their own. Market conditions are influenced by a myriad of factors, and windows should be interpreted within a comprehensive analysis framework, incorporating multiple indicators and market sentiment analysis. Another common mistake is overlooking the role of trading volume as a confirming factor for the significance of a window. A window accompanied by a substantial increase in trading volume is typically a stronger signal than one occurring on average or below average volume. This oversight could lead to underestimating or overestimating the window's potential impact on future price movements. Lastly, there's a tendency to misinterpret the function of windows in different market phases. For instance, a window in a steady, trending market may have a different implication compared to one that appears in a volatile or range-bound market. Recognizing the market phase is essential for accurately assessing the significance of a window and devising appropriate trading strategies in response. In summary, while windows are valuable tools in technical analysis, they must be interpreted carefully, considering other market indicators and conditions to avoid common mistakes and misinterpretations. In trading, a window refers to a gap that emerges between two adjacent candlesticks on a chart, showcasing a space where no trading took place at the price levels within the gap. This phenomenon typically indicates a strong shift in market sentiment that can lead to significant price movements. Identifying windows can be crucial for traders as they often serve as key indicators for potential entry or exit points in the market. When it comes to strategies for determining entry and exit points, spotting a window can offer clear signals. For example, a window that appears in an upward trend might suggest a continuation of the bullish momentum, urging traders to consider entering a long position. On the other hand, a window found in a downward trend may imply further declines, prompting a decision to either short sell or exit long positions to avoid potential losses. Traders might also look at the price action following the appearance of a window for confirmation. If the prices start to fill the gap, it could signal that the initial surge in momentum is fading, and it may be time to reconsider the position. Close observation of volume patterns during the formation of a window and in subsequent sessions can further inform the trader's decisions, providing insights into the strength of the market's move. In summary, windows signify strong market movements and offer valuable insights for strategic entry and exit points. By meticulously analyzing these patterns in conjunction with other market signals and volume trends, traders can make more informed decisions and better manage their risk in the volatile trading environment. A window in the context of technical analyses refers to a gap that represents an area on a chart where no trading has taken place. This gap appears between two adjacent candlesticks, showcasing a sharp move in price, either up or down, with no trading occurring in between these price levels. Gaps or windows are significant because they indicate a strong sentiment in the market, either bullish or bearish, depending on the direction of the move. Exploring variations and similar patterns, it is important to understand that not all gaps may signal the same outcome. Some gaps are followed by a rapid movement in the opposite direction, known as a filling of the window. This happens when prices quickly return to the original pre-gap level, displaying the temporary nature of the sentiment that caused the gap. Other times, gaps can signal the start of a new trend, remaining unfilled and serving as a historical point of market sentiment shift. The primary variations include common gaps which occur regularly and are often filled quickly, showing no significant change in market sentiment. Breakaway gaps which signal the start of a new trend, runaway or continuation gaps that occur within a trend, confirming its direction, and exhaustion gaps that occur near the end of a trend, indicating a final push before a reversal. Understanding these variations and patterns helps investors and traders to better interpret market movements and make informed decisions. Each type of gap carries different implications for the market's direction and investor sentiment, making the analysis of these patterns a valuable tool in the technical analyst's toolbox.